right. What's up, everybody? And welcome in. I'm so excited to have you all here for our special event for the month. We have, and Tom, I said this on my call earlier today when I was teasing this call. I was like, listen, I'm a good trader. I've been trading since 1997. I've been trading options for 10 years. I've learned a lot. I'm like, but you're much better. And we love coming on here and learning from you and having you make us better. And everyone really, they say these calls are the best. So it's I say it every time because I mean it. And really appreciate having you here.
Well, thank you. But much better is a very relative term. You know that because in this business, you're only as good as your last trade or your last month or whatever it is. So, you know, um,
No. You are better. I see it in so many different ways, and you've made me better. And usually when I trade poorly, it's just going back to my old stuff.
well, the funny thing about this business or the funky thing about this business is that we all, you know, need to get. I hate to say this, but every once in a while we just need to get slapped. Like you kind of have to do something stupid just to wake up because when you string together a couple winners in a row, you start to get cocky and you think you know something, and then you need to actually just be brought back to earth very quickly.
My thing now is more like I enjoy trading, and yeah, if I'm
Yeah.
trading well, I think like, oh yeah, like I mistakenly think like it's like the ocean, like it's not dangerous. I could swim in it, and then all of a sudden there's a rip current. And I get this idea in my head. If I have something expensive coming up, I'm like, I'm gonna go pay for it today. That's when I do something stupid. When I try to turn it into like a cash machine for the day and make a big move, that's wrong. But I actually today was good. I did buy the dip in SoFi this morning. There's been so much like bullish buying pressure on that stock, and it's just a favorable stock this year. So once it got back above 10, like once it dropped below 10 on earnings, it was trading 70 cents higher pre-market at 7 in the morning. Dropped below 10, it came up, and I just bought some short-term options, sold some puts, and then I got out of all of them by the time it hit like 1060.
I sold a few crappy puts in there before earnings, and I just took them off. I mean, I think I lost like 4 cents on it. It was nothing. It was a crappy trade. I didn't like it because it had run up so much, but I also didn't want to get shorted just in case they blew the doors off. So I kind of was on the wrong side a little bit.
Well, literally because of things we've learned from you and how we structure our trades. The trade I have on in my service, we bought not today, like we've been in December 20th SoFi call, and then we were selling weeklies against it. So we had sold the November 8th 1150.
Oh, I like it. Yeah.
And so when it dropped, we were all good. We were still up on the trade, which was fantastic. And that's just a matter of knowing to collect premium, how you structure the trades. I had a quick question from last time, and then I had another question I just wanted to jump into right away.
Sure. Fire away.
Last time you showed us something on the screen where you could see how the option price is traded for the day. And can you show that again? Like you could see like highs and lows, right, for the option price?
Yeah. Yeah. Hold on a second. Let me go to how. Let me. Let me. Can they pull up the? Let me see something for a second. Can you make the screen full screen?
There you go.
Oh, perfect. Okay, I think that works. So let's say, oh no, for some reason I can't click on anything. Hold on, I got to figure out how to share this thing. I'm just not used to this. Hold on one second.
Oh, just because we're using a new technology to present.
Yeah, this is my mouse.
I just want to be clear. It's not that you're not used to Tasty Trade, which you invented.
No.
I just didn't want that to come off wrong for anyone who's new.
when I moved my mouse on here, it has a lower mouse. I can't figure out how to get that.
I do that, but it's funny because your Tasty Trade screen is up and the mouse is moving. You're like, let me figure out how to work this thing. I'm like,
yeah, no.
He knows how to work it.
Hold on, I'm gonna do this the right way.
And by the way, for anyone who hasn't figured it out, I will be going to the Yankee game tonight right after this call. Super excited. to see the Yankees redeem what happened to them with the Boston Red Sox when they gave up a 3-0 lead. We're going to go back the other way now.
All right. Now, sorry, I'm on a full screen now, so you can actually see it, and I can move my own mouse.
Perfect.
Okay. So you were talking about SoFi, right? I didn't trade SoFi today. I just had the stupid, crappy little earnings play on. So let's say you went to
November 15th. I had the November 15th.
November 15th.
10 calls I bought.
10 calls. Okay. Yeah. Well, if you right click on the 10 calls, you can do the option in a chart on Tasty.
View option.
There you go. That's the 10 calls.
And then you could change that to
you could change it to anything you want, like any normal, chart. You can do anything you want with it. But the bottom line is, when you're on any page here, you can just right click on any quote and just hit view option and chart. That's all. And if you left click on the quote, you trade. You hit the bid to sell, you hit the offer to buy. That's all it is.
Okay, so the chart will show you how that's showing you how the option price traded, right?
Yeah, that's what you asked for, right? The option price.
I just want to make sure.
Yeah. You just right click on anything and just say view option, and that's all it is. It's
okay. So the high was 52 cents.
I don't know why it's a little slow right now. It might be just because we're on this software that you had.
It probably is. That usually slows it down.
Yeah, it's just a weird thing, but it shouldn't be any problem at all.
Yeah, I just like knowing that. And I wanted other people to see that, which is cool. Okay, a lot of baseball comments. Don't you guys? You must be a Cubs fan. You guys sponsor like the Cubs and the Bulls, right?
Yeah, not the Bulls this year. We did last year the Cubs and the Bulls. This year we only sponsor. I mean, this coming year, we didn't sponsor the Bulls, but we're sponsoring the Cubs.
Let the Rosen go. So yeah.
Yeah, we just re-signed with the Cubs for 3 years, so we're on the pitcher's mound in Chicago, which is kind of cool. So every pitch you can see, the Tasty logo, and it's cool. I don't know what they have at like Yankee Stadium if somebody bought the mound, but that's what we did. We own the pitcher's mound at Wrigley.
That's awesome.
Yeah, it's fun. It's fun. We go to. I actually live in Wrigleyville, so I walk to Wrigley, go to the games. It's great.
That's amazing. So do you go to a lot of them?
No.
But when you do, your logo's on the mound.
No. You can't see it when you're there. It's you can only see it on television.
Okay, I like that.
When you're there, we're in the outfield on all the on all the signs. But and Wrigley. Have you ever been to Wrigley?
Yeah, of course.
It's awesome.
I went to a bachelor party baseball game. I also had beer dumped on my head when someone hit a home run in the bleachers. Yeah.
Yeah, Wrigley is awesome, and but we're not on when we originally did the deal like 3 or 4 years ago, we were painted on the mound, but the pitchers kept stepping to the back of the mound, and they would clean their cleats off, and they would they basically would just ruin our logo, not intentionally. They just would walk all over it. And you couldn't see it after like the 3rd or 4th inning, so we had to go back to the Cubs and work out a different deal.
That's funny. Wait, I do want to. I haven't actually another question, but I want you to introduce your team. I see people are already answering questions. We have a lot of people here today. So
Brittany's on, and Quentin's on. Quentin is one of our reps. He's on the trade desk, and he's been a Tasty trader since he was about 12 years old. So I have a long history with lots of Tasty traders that started when they were young and went through college, and we stayed in touch through all the years. And when he got out of school, he went to Alabama. He was a finance major, and when he got out of school, we brought him onto the trade desk here at Tasty, and he's been awesome. And then Britt is on answering questions, and she's been with me for the last pretty close to 10 years. So she works on my team.
Awesome. So if you guys have any questions about anything in terms of the platform or anything, you can ask him on the right.
Yeah, Quentin is very clear on the concept, can tell you anything you want to know about the platform. He knows it inside and out. Nothing's off limits. And Britt can answer any other questions you have about Tasty. And if you want to write to me afterwards, I'm just Tom at Tasty Live, and I answer all my own emails. And so write to me anytime you want.
All right. Now I want to just this is another question. It's not really option related, but I am curious with the ultra leveraged ETFs.
Yeah, sure.
Are they on a highway to zero eventually? Do they all end at zero?
Um, Pretty much so. So, like the thing with ultra leveraged ETFs, and they're triple leveraged ETFs, and triple or double leveraged ETFs. It doesn't matter which one. Do you have a symbol for one? And I'll if you have a commodity one, it's actually a little easier to show.
MSOX for
Which one?
MSOX for cannabis.
Yeah, that one's a little less interesting because there's not really a cannabis future, so it's harder for that
My
one.
buddy was telling me he trades the SQQ all the time, and I'm like, doesn't that eventually go to zero? He's like, yeah, but it's good on bad days.
Okay, so there's different. So any kind of triple leverage, you have to get the leverage somewhere, right? The whole thing with triple leverage, like the easiest way to explain it is something like, I'll go to UNG just because it's natural gas. It doesn't matter. You can go to crude oil or whatever you want, but when you have, actually, you know what? UNG is not a multi-leverage. What's the one that's triple leveraged? I can't think of the one in natural gas. Well, anyway, I don't trade a lot of triple leverage things. That's why I'm spacing out on some of the names. And the reason I don't is because the only reason to trade a triple leveraged ETF is if for some reason you can't trade the corresponding future, because the corresponding future has significantly more leverage and requires less capital than the triple leveraged CTF. The triple leverage ETF. So a triple leverage ETF does not get any capital relief. They're basically fully margined, and so there's no capital efficiency in it. So it's not. That's for one reason not really a good product to trade. The second thing, like let's see.
Oh, it's 3NGL.
3NGL. Okay, it doesn't really
That's
matter.
Wisdom Tree natural gas 3 times daily leverage. By the way, the AI on Google has gotten so good.
Yeah, that doesn't actually work. So it's something. This actually something different, but it doesn't matter. Let's just try it like one of these, like SQQQ. Like here, like this is the SQQQ is like an ultra, is like a ProShares ultra short, whatever it is.
Yeah.
NASDAQ. But there's a couple things with the ultra short or the triple leveraged ETFs. First of all, you don't get much capital relief at all. In fact, it's significantly worse than using the corresponding future. The second thing is, because the way that they get the triple leverage is by using futures, they have to basically pay for the future roll going forward. So if a future is in contango, which most futures are about 85% of the time, contango just means that the front month is down here and the back month is up here. What you're doing all month is you are buying back your front month and you're selling the next month, or you're selling the front month and buying the back month. Either way, you're paying this spread between a lower front month and a higher back month. And so what happens is there's this natural drag as they roll forward every single day. And the whole thing with the triple lever product is that you need it to outperform the rate of decay. The highest rate of decay of anything is in the volatility futures, because those have the highest volatility. Volatility on volatility is the highest of all the products. But outside of the volatility futures, they all have a natural drag built into it. And so just be careful. If you're using triple leverage futures, just use them for the day and at max 2 days, but don't go any longer than that.
So, and by the way, my questions were for people not to trade them. I wasn't trying to tell people to trade them. I was just trying to get to like a hard, concrete answer about why it's bad. Sure. But now that you're saying that, though, would it make sense to buy a long term in one of those and then sell against it weekly?
It's an arb that you can't afford. So what that means is, and I'm not saying it you cannot afford it. It's an arb that retail customers cannot compete with the prop firms that don't have any capital requirements. So what happens is, in order to maintain liquid and efficient markets all over the place, members of various exchanges don't have intraday capital requirements like retail customers have. And they don't have overnight requirements that are the same. Their requirements are like 20 to 1 instead of 2 to 1. So what happens is that all of the arbs between the levered ETFs and the individual stocks or the ETFs themselves, they call it like there's some form of a dispersion trade. All of those arbs are sucked up way before you could do it as a retail investor.
By the way, people are chatting in with names. A lot of people mentioned Boyle.
Yeah, Boyle was the one I was thinking of. That's right. Yep.
And
That's right. You're right.
Thank you, Six Doubles and Brody and everyone else who wrote Boyle in.
That's right.
And then Drip.
Hate that stock, by the way. Hate that stock.
And SPXL.
Yes, that's another one, SPXL. The S&Ps are a little different because the S&Ps aren't necessarily, they don't have the same kind of contango and backwardation so the index products are a little bit different. The problem with leveraged ETFs is when you try to replace, like if you make $1, lose $1, you're still down money. And that's the hard part. And so it's hard to come back. They're very good if you're looking for an intraday trading vehicle because you get a lot more bang for your buck. But they're not very good if you're looking for any longer than, 1 or 2 trading days. Not at all.
By the way, going forward, for anyone who's paying attention right now, and you guys have to remind me because I'm not doing this. Anytime Tom won't remember in a month, so that's fine. Anytime Tom says the word contango, because it only happens like once a year. It's very rare I ask a question that gets contango as part of the answer. So anytime he says the word contango, chat me in, and I'm going to give everybody a prize who chats me in for it's kind of like the drinking game on the buzzword. If he says that word, if Tom says contango on a different call and you remember this moment right here, remind me, and I will literally send you something valuable because I think it's that rare that it comes up.
Okay, I'm going to give you a quick little lesson in contango and backwardation just for fun. So I pulled up crude oil, right? And crude oil's usually in contango. That means that the front month is lower than the back months. You pay more for later on. But right now, crude oil, the front month in November is 67. The December crude oil is right here. You can see where my cursor is 67.12. And then it starts to go lower, 66.80, 66.50. All these months in the future are lower. That's what we call, that's backwardation. That's when the front month is higher than the back month. That only happens like less than 20% of the time. And then if we look at another product, just for fun, I'm going to take a little look at gold. So this is /GC. This is the gold futures. And as you can see here in gold is in contango. The front month is 27.86. The back month is 28.11. And then the next month after that is 28.30. So that's an example of gold is in contango, which most underlying futures are. And crude oil right now is in backwardation.
By the way, I got, first of all, there's a lot of people on this call because I just got like 100+ chats in a row saying he said it. I said on a future call, guys. We were talking about contango right now. I didn't mean right now. I meant on the future. And by the way, everyone says boom. All these different people are like boom, boom, boom. It's pretty funny. I meant on a future call. And I'm happy to give a prize. I always honor my word, but I wouldn't bring that up as we're talking about contango and say if he says it again. Anyhow, that's funny. And then, okay, so I have another question about ETFs, and I'm happy to move on that subject because they're a little.
Go ahead. What's the ETF?
No. Just for the indexes. And right now, as I sit here, I have a piece of paper that's taped to my computer that says, "Don't short the stock market ever." So I like if I looked at my P&L for the year, 80% of my losses are trying to buy puts in the Qs or the SPYs for the day where I think we're going down. Now, when you see them move, this is my question. So like the Qs is made up of the components of the NASDAQ. It's weighted against the NASDAQ. It's not necessarily that like people are calling up their brokers to buy, so they have to buy those things now and the Qs are going up. They trade separate from their assets, correct? Like
No. When you say you're talking about, you think the Qs trade independent of their underlying assets?
For during the day?
No. The ARB is perfect all the time. I mean, it can get out of line from anywhere from like, let's call it a few milliseconds to maybe 5 to 6 seconds, but no, it's never out of line. There are literally hundreds of firms all over the world that will push a button for all 100 stocks, or that will push a future against an option combo, and it will never be out of line, ever, not for more than a second or a couple seconds.
So if NVIDIA makes up 5% of the queues,
Yes.
and someone comes in with a massive sell order in NVIDIA,
Yeah.
that will move the queues down by that percentage.
100% of the time. Not even, it's not even
in real time.
Yes, in real time, tick for tick.
Okay. I didn't know
100%.
that.
There is not even, this is the world of stock market efficiency, and it's been this way since 1987. Like this is not some new kind of crazy phenomenon or something like that. The various ETFs and indexes and whatever, anything that can be programmed into a stock option or futures contract, they're all equal to the same exact thing. They will arb that out of there in a matter of a couple of seconds, maximum.
Speaking of 1987, I heard today that the market confidence index originated in 1987, and that was the highest it was. And we are now at those 1987 highs, coincidentally now.
I did not hear that.
Yeah.
But I did a
37
show.
years later, we are as confident as we were right before the market crashed.
On October 19th, I was doing a show in LA two weeks ago. And it was Saturday morning, October 19th, and I told a bunch of stories about the crash in 1987 because I was in the pit and I was 30, and it was the first time, it was the first time we had experienced anything. I mean, nobody had ever experienced anything like that, but it's that day stuck with me for I think I can remember every single trade I made and every single tick that entire day and every single event of that day. It's like, you're right. 37 years later, not one aspect of that day have I lost in my memory. Every single thing I remember. Tony's the same way. It's crazy.
I have that. It's funny. I wouldn't know the date, but it was around 2000. There was like a NASDAQ correction day where it had been getting really beaten up and had this crazy rally. And I remember I was buying like eBay and I can't remember every deal yet, but I remember a lot of the trades. I remember that, but I think your memory is better in that regard. But
well, I only traded one at the time. I only traded the S&P 100. I mean, you couldn't trade multiple products. So yeah, I only traded an index product, and that was the largest index product of the world at the time. So yeah, I remember everything that did crazy. But anyway, let's move on. Yeah.
I have some questions. There's questions coming in that take a second. I forgot. I have one more question regarding ETFs. So they have this new product, and they have it for general tech and also individual stocks like NVIDIA and stuff like that. But the one I've been in is YMAX. I don't know if you've heard of these. They're like structured products where they're selling options against the stock. And so like YMAX pays a weekly dividend. It's called Yield Max. It pays a weekly dividend and pretty much just stays there because they're collecting premiums and stuff like that. And they also have it for like specifically NVIDIA, where you could buy this thing and they're selling calls in NVIDIA against the stock for you, and you can get out dividends. Have you looked into that at all? Or
I mean, no, because first of all, I can do it myself, and so I don't let anybody do that for me. But the other problem with it is it's a bull market trade. I mean, that's the kind of trade that the day we have a sell-off, that trade's done. Whether the sell-off lasts, 2 weeks or 2 years, that trade is over. I mean, you're basically just, all they're doing is selling weekly. It's synthetically selling weekly short puts in NVIDIA. And as soon as that game's over, it's over forever. It's not, to me, it sounds good because people are doing it because it's working. And as soon as it doesn't work, people will be like, well, that was a nice try. It's not my thing.
No, that makes sense. And people have said that in my community. And by the way, that's my favorite thing about what we do still, because you started trading literally in a pit. When I started trading, it was rows of people on computers.
Yeah.
But there was a camaraderie of people yelling stuff out, and literally you could trade based on the buzz in the room. Like you could feel the market based on all the people around you. And so the closest thing we have to that now is these audiences. So I love like little things like when you're trying to remember the name of the symbol and 7 people write it in or whatever. Like,
oh yeah. No. I love that. Yeah.
So Henry said, I remember 1987, blood all over the place. Harold Z said, please ask if he has ever, the people, wait, sorry. Yeah, probably. He said, yeah, I didn't like the question. That question was weird, so I started reading it. Bradley said, do you have some quick rules of dates for a calendar spread? Maybe selling the November 15th, 2024 and buying, say, the January 17th, 2025 call.
No, I do have quick rules for calendar spreads. So first of all, the perfect time frame for me in a calendar spread is like 60-30. I'm fine with 90-30, but I won't go inside. Like if you said to me, are you going to sell November 15th right now? There's only 17 days left to go to November 15th. My answer would be no. So I don't worry about inside of 21 days, I don't sell. So my perfect time frame would be 30 or 35 days on the short option. And if you're going to do it without a skip month, then I like the 60 days. And if you're doing it with a skip month, I go to 90 days. So I don't care, if you're going, 3 month, 1 month, or 2 month, 1 month, whatever you want to do. But it's 90, 60, 30 is like perfect. And if you're looking for delta, we've done a lot of research on delta, and you probably want to be in that 30 area, like the perfect part of the decay curve. So you're probably better off bullish or bearish on the put side, bullish on the call side. You want to be around that 30 delta. And for calendar spreads, they don't really start to, they're low risk, low reward until you get later on in the cycle. But so you might want to consider taking profits if you have them anywhere between 15 and 35 or 15 and 40% of the debit you pay.
Makes sense. Well answered. Thank you. How about future in this call? Future in this. They were talking about that, the Tango thing. So now we have, are there any election trades? Like, do you feel like the election is an event significant enough that it's like almost like an earnings date or something like that?
Oh, yeah, I do. I feel there are a number. So some of my biggest positions right now, I feel that there are a few election trades. On the bullish side, my favorite position is the bonds, and I don't care if you buy TLT or you buy, like, these are bonds right here. These are ZBs are the bonds. So ZBs are the 30-year bonds. That's my favorite position. They traded down to 116.26 today, and then these are the notes. These are 10-year notes. Their only decent ETF for bonds is TLT, which trades the long bond, but this thing is on its freaking butt. It's been murdered. Take a look at this. This is the last couple of weeks, and they've absolutely destroyed bond. This is when they, right here is where they lowered rates by 50 basis points. Right here at the top. Ever since the Fed lowered rates at 50 basis points, the bond market has basically crashed, and interest rates have gone sharply higher. We haven't had an uptick in almost 3 weeks. And so this is where we got down to today. I think we made a really important low today. And I love the bonds and I love the notes. It's my favorite election trade, both of those. I want to bet that interest rates are going to go lower after the election. I also, and I know these are commodities, but we'll talk about some stocks in a second. I also really like, and I know you guys don't trade this. Let me bring up an ETF that you will trade. So I'm very bearish on the US dollar here, and the US dollar's had a massive move to the upside. So this is the euro. Now, I don't use FXE. I use /60, which is the actual futures contract for the euro. But this is the euro chart. It looks exactly like the bonds. The euro has basically crashed, and the US dollar has been, as bonds have gone lower, the US dollar has gone higher. So British pound. It doesn't matter what it is. It could be the yen, any any currency against U.S. dollar, and I love shorting the U.S. dollar here. That's my second favorite. Um,
So is shorting the U.S. dollar? That's you're buying that or you're selling that?
no, I'd be buying FXE or buying the euro in that case.
That's going against the U.S. dollar.
Yeah, yeah, sure. Yeah, if you're buying the euro, you're selling the dollar. I also like for stocks.
Well, where are we in that trade? I'd like to understand that a little bit more because
Here, I'll show you. They even have micro contracts too, so it's not like these are very popular. These are very popular contracts.
I honestly never follow. I follow stocks. I don't follow currencies.
I know, but this is something because they don't really have ETFs. They're not capital efficient because the volatility is so low. Look, 220,000 of these euro futures traded today, and look at this crash in here. This is just this since the Fed lowered interest rates here, the euro has absolutely crashed. That means the dollar's exploded, and these are some of my favorite positions. Is buying euro here, buying Japanese yen, or any combination of any of that stuff. I love it. Also, if you're looking for stocks, I got a couple of stocks too that I kind of like here. Boeing is one of them. Boeing's a stock that I think is a good election play because I think that this stock has been beaten down so much. It was up big today, $2. I was actually only up $2, but this is a stock that hasn't had an uptick in a couple of months, and I kind of like it here. Relative to a couple of other stocks, I kind of like Boeing, and I also still like as an election play. I do like a bunch of Chinese stocks. I think they're really cheap as an election play, and Baba's another one. It's come down a little bit, but it's not anywhere near its lows. But it's come down pretty nice. So is Baidu and those kind of stocks. So I do like those I like all of these on the long side. On the short side, I got a whole different slew, but I am very bearish on the S&Ps after election, after this rally. You just mentioned it before on the, the level of capitulation to the upside, the level of complacency. I feel like the S&Ps and the NASDAQ are crazy rich relative to the, this is the only index I'm buying right now is the IWM, this index, because it hasn't had anywhere near the rally. That's the Russell 2000. But I don't like the SPY and I don't like the Qs. And these are indexes that I'm definitely short. And I'm also short a lot of equities. Like, for example, one of the equities I really don't like here is Apple. And looking to get a lot more short Apple up here.
I mean,
that's my 2-second.
By the way,
what do you like in the direction?
By the way, this is crazy. I don't even we never go. We don't usually get this. We usually are more topical, but this is reminiscent of when I heard you speak live at some of the trader expos, and people will be like, "What do you like? What do you don't like?" And you used to go.
I'm a junkie. I made 100 trades today, so I was all over the place. I trade a lot of bonds today, but I was all over the place. I was everywhere. But there are a lot of things. I think we've gotten to a point right now, prior to this election, where I'm a contrarian on everything. So I think this election is one of the greatest buy the rumor, sell the news elections that I've ever seen. So anything that's up big, I don't like. Anything that's down big, I like. I know that sounds like really general and almost a little bit lame in that sense because I'm not picking and choosing. I'm not giving you any macro or fundamental reasons, but that's not how I trade. Anything that I think is oversold, I like it. Anything I think is overbought, I don't like it. Like gold and silver and all those things, I can't stand them here. I wouldn't be long any of them.
The FXE, I assume you don't trade that, right?
Which one?
FXE.
I do not because it's too expensive a stock. Here, I'll show you why.
And it wouldn't move as much as the actual futures that you would want to.
No, the futures, here's the reason you can't trade the stock. It's $100 stock, right? And it only has 6% volatility. So the expected move for a month is absolutely nothing. So you have to trade the futures because the futures have the same volatility, 6%, but they have 6 times the leverage. They're the exact same product.
Right.
Like in this day and age, every product is the same. So like if you're looking at the 6E futures, they're the same as FXE. They all basically even settle into each other. They're almost one for one. So it's not it's you have to be relatively product indifferent in today's world. That's all.
So like with Boeing, now you're not going to buy an out of the money call. That's not your style. So I would assume if can I guess how you would trade it, and then
Sure.
because I think I know you pretty well now. I think coming into November, so you probably go out to like a December 20th, if not sooner. Maybe November 15th, because that's after the election, close enough after the election, and then you'd sell like a 147 put.
Well, today all I did today, I'm already long Boeing, but today all I did in there was sell the 45.50 put spread. But that's because I already have a bullish position on in there, and I just wanted to make sure I stayed long.
Whoa. Oh, okay. I got excited for a second. Wait.
Yeah, but no, I didn't really do anything in Boeing today because I've been a little bit sucking wind in that stock, and so I'm already like long.
Wait, but it says B2C and sell to open. So you closed some of the 145s and went up to the 150. You got a little more aggressive in it.
Yeah. Right. I rolled up.
Yeah. I thought you put on a spread for a second. I got excited.
No. I didn't put on a spread. I just rolled up. I just rolled up some short puts to get more long delta.
How long had you been in that trade before you rolled it up?
Oh, probably a couple weeks. I've probably rolled it a bunch of times. I mean, Boeing is like, how we have option chains on here, right? So these are all. So if I go to the bottom of the page here, these are all my Boeing trades just from here. Let me go up to here. These are because we track all the trades. So just of the trades I have on from October 1st to today, it's everything that's here that I'm scrolling up on. These are all Boeing trades. Every single trade here. But, I've been long a lot of Boeing and we're up a little money in here, but still, that's all.
TLT, you said you were bullish?
I am. It's a way to play bonds to the upside. I don't have a very big position in there because I really use the bonds. I don't really use TLT. So I really have nothing on in here, just a couple little trade. I haven't really looked to see the long delta, but I don't really know what this is.
For TLT to go up, what would bond prices tend to do?
They have to go up.
They go up.
Yep. Bond prices go up, TLT goes up.
So that means interest rates go.
Yeah, like this trade right here. These haven't done much in here. You can see.
Do you think interest rates will go higher?
No, interest rates will go lower. Bonds go up.
That's what I was thinking. So interest rates go lower, bond prices go up. So you think rates are going to come down?
I do.
But that's not contrarian, is it?
No, that is very contrarian because rates have been exploding rates have exploded over the last 3 weeks.
Oh, they have. Okay, okay.
Yeah, no, rates have gone straight up for 3 straight weeks.
So do you know what the 10-year is at right now?
I can tell you.
Sorry.
So the nice thing about
I don't need to ask you as if I'm asking my Morgan Stanley advisor. I'm just curious.
No, but the nice thing on these platforms is that there are different underlyings that actually just track the 10-year. So if you go /10Y, that is the 10-year note yield. So the actual yield on the 10-year note, and this is a tradable market, is 4.21 at basically 4.22 is where it closed today. That's your 10-year yield.
I want to read a message from Brittany who said, I want to write before I depart. Please sign up for any of our upcoming events to see TomTastyLive.com/events. If you have any questions, please email Tom at tastylive.com. Any questions regarding the Tasty Trade platform? We have the best trade desk team to answer your questions. Please email them at support@tastytrade.com. That was good. Eli said, I scalp futures professionally with options. I don't care about Delta, etc. Is there a book that would give me ins and outs of options that I don't have to learn the little things that cost money that experience can provide.
The greatest book ever written on options was written, in my opinion, by Julia Spina.
Recently, like a couple of years ago, right?
Yes, she works for us. She's amazing. She's young. She's crazy smart, late 20s, a physicist. She's absolutely brilliant. And hey, Britt, if you could post a copy of the book in there, um, you can see it's not expensive either. It's like I think like 20 or 25 bucks on Amazon. We don't sell it, but it's been the best selling option book for the last 3 years. I think she's sold almost 100,000 copies, and in my opinion, it's the best book. All I did was write the forward and help to finance it, but it's just an amazing book. It has all our methodologies in there, and all of our mechanics are built into that book.
And her name was Julia?
Her first name is Julia. Her last name is Spina, Spina. She's a Chicago
Unlucky Investor's Guide to Options Trading.
Yep, Unlucky Investor's Guide. And Julia was she's a genius, and was a physicist when I hired her, and now she's building a lot of technology for us. She's incredible, and the book she wrote is amazing. Best book on options I've ever seen.
What's your favorite bullish Elon Musk company right now?
Well, so I drive a Tesla, but I'm very sour on Elon at the moment. So I'm not a fan, and I don't have, I love my Tesla, but I'm not an Elon fan right now. So I'm not going to go out on the ledge for him. I don't really have a favorite Elon. I'm not an investor in any company he has.
Okay.
I'm short Tesla, if that helps.
Is that an emotional play, or is that a...
No. I thought it ran up too much on the earnings play, and I thought it ran up too much on earnings, and so we've been actually collecting some pretty decent premium in there the last couple of days. I think Tesla and Nvidia are the two best trading stocks. If you're looking for equities, I think Tesla and Nvidia are the two best trading stocks in the world. So in the equity marketplace, so you have to pretty much trade Tesla and Nvidia because those stocks have the most volume and the deepest liquidity, and you can basically do anything you want one tick around mid price.
Mike said, do you think the market's in a price bubble?
I do, but the problem, Mike, is that it's been there for a long time. Like, this is not like a short-term price bubble. We've been at levels that are hard to rationalize. I mean, we sit around and we look at companies like Nvidia, 3.5 or 3.6 trillion, and we're like, oh yeah, that seems right. And you can't even put those numbers, like you can't even fathom that kind of stuff. It's insane. So I think we are, but we've been here for so long now that I don't know, maybe it's normal. I don't know. I just trade them. I'm a junkie. I just trade them. I don't try to overthink anything.
Karen said, can I ask about Dash? I never hear anyone talk about the stock rocketing up over the last few months. Earnings are tomorrow. Would you play this into earnings?
And the reason that we don't play Dash, is that Robin?
Karen.
And Karen, the reason we don't play DoorDash, mostly the reason is just because of the relatively light volume. Now, I know that somebody did a big spread in here today. It looks like 1,000 of the 150, straddles traded or something like that. But when you look at the volume in here on most days, now this is getting right before earnings, but when you look at the volume in here up and down in December, and November has a little bit more volume, but it's still kind of light. The reason we don't trade a lot of DoorDash is just because the markets are about 20 cents wide in the front month. And if you go out to December, they're still about 20 cents wide each strike. And, if you had to pick a earnings stock to trade with all the companies that are coming out with earnings, and you look at this volume up here of 3.9 million, it's a tough earnings trade. I mean, look at the price. It's $155 with a 46 IV rank and 3.9 million shares trading. I'm going to show you something. I'm going to take you to AMD just as a comparison. This has an IV rank of 86. So it's double. As far as the level of volatility in AMD is double DoorDash. The price is exactly the same, about 155 bucks. Close 166, is had earnings tonight. It's 155 right now. And it traded, instead of 3.4 million, 68 million shares. So the way that our minds work is, if you need liquidity and you need efficiency. So why would I trade a stock with a 46 IVR and 3 million shares trading when I can trade AMD, which is the exact same price, with double the implied volatility rank and 20 times the volume? That means 20 times the efficiency. So that's the whole reason why people don't talk about DoorDash, because it just, unless you have an axe to grind in DoorDash, stocks like AMD and other stocks like that are just a lot more interesting for traders because they have greater efficiency and lots higher implied volatility.
I want to parlay that into Jim's question, which was, if Tom was going to sell credit spreads on Mondays and Wednesdays that expire on Fridays, what types of stocks, because I think it's a similar answer, would be best, and what criteria would he use to determine the short strike? Example, I was selling SMCI credit spreads weekly pre-split, but it all went away after the split as the premium shrunk.
Yeah, you can't trade. Who's this again? Which person?
This is Jim.
So right now, SMCI is way too illiquid. It's almost untradeable. I know it's surprising, because for me, I thought when SMCI split, it would become a lot more liquid and much more tradable, but it's actually gotten worse. And I'm sure you've experienced the same thing, because I had a bunch of positions on there. I finally took them off, and I'm like, I'm not trading this stock again for a while. So I'd stay away from SMCI. You want to go where there's the most liquidity. There's no reason to trade SMCI when you can trade AMD, NVIDIA, or any other, or SMH, these stocks with just, I mean, if you don't have a particular stock, I mean, SMH, is a way cleaner stock. You can trade these about 1 penny around mid price, and it's an ETF, and it covers all the same kind of, semis, AI stocks, whatever you want to call it. And, but you can trade, NVIDIA, which is, the volume in these things are insane. We're up to 155 million shares here. These are liquid markets. If you're going to trade the weeklies, you want to be in the most liquid underlyings, but you want to have the highest implied volatility rank. So, that's where you need to find things, and you need to kind of search by, hey, what has the highest implied volatility rank and the most volume? Because that will automatically give you the most option liquidity. Then you drop down here and everything trades in the thousands. So that's what you want. And like you mentioned Tesla before, here's another stock that trades just a ridiculous amount of volume, 80 million shares, and huge option volume, thousands on every line. And this is post earnings. So these are way more interesting plays to us, especially on a weekly level, than something else.
Jim, that was a good question. I'm giving you a bonus question. You said, if I'm bullish on a stock, 200 plus shares, when it breaks its last pivot high and the at the money calls are expensive, $15 plus, what is the best approach? Buying a 10 to 30 wide debit spread, 10 contracts leg with long call at the money or slightly in the money, or simply buying the expensive calls but just fewer of them? Or selling the put is another option, which hasn't been mentioned. I'm adding that. So I get that. You're bullish a stock. It's expensive. You don't want to buy the stock because it's too expensive. You think it's going to go up, but the premium's price for it to go up. What do you do?
So let's use Tesla as an example. The stock's been very strong. It's jumped from 200 to 260, whatever.
You think it's going to go to 275?
You think it's going to go to 275? I mean, so a couple of things here. So my first thing, Jim, is I would probably buy an in the money call spread. So and again, the reason that you're doing this, the reason that you're doing this is just because you want to pay the least amount of extrinsic as possible. So if, let's say, you thought the stock was going to 275, the expected move by December, by the way, is $36. So with the stock trading at 260, the expected move to the upside is all the way up to 295. So 275 is a very reasonable expectation. So I would do something like buy the 250, sell the 270. Okay, this is $10. Now, just let me show you why I like this kind of trade for what you want to do, Jim. It's a $20 wide call spread. You're only paying $10.18 for this. The stock is trading at 250. This is where it closed. Just forget about this price because that's after hours. It closed just under 260. that means you're essentially paying no extrinsic premium at all. It's worth $10. You're paying $10. Now you're going to have to hope that the stock moves your way. You're going to make less money if you're right, but there's no extrinsic premium. You're not going to get chewed alive with decay. If I clear this trade, and let's just say you bought the 275 calls thinking that we're going to go up to 275, the problem with this is, you're going to have an incredible amount of daily decay in here that is going to be just, expensive. You're going to lose, you can do the math, but 52 days into $15 is just going to be a very expensive amount of decay if that stock doesn't go higher. So there's going to be a lot of potential. This stock only has this trade, even though the stock's supposed to go up to 90 or could go as high as 90, this stock has about, a 40% chance of being in the money and a 60% chance of not. So I don't like the negative pop. I much prefer the long call spread. And just like Adam said, you could also sell an out of the money put spread and give yourself a higher probability of profit.
Thank you for answering that. Hey, Lee, I just want to answer your question. I love Lee. Lee's such a good guy. Really like you, Lee. Love seeing you on these calls. Always smile when I see your name. Lee said, how can I learn to use Tasty Trade when I barely know think or swim? And
Tasty Trade is very easy.
Queen provided the YouTube channel and
yeah,
some other things. And Lee, you're part of our community, and we obviously know Tasty better also. So Jim appreciated the answer to those questions very much. John said that Tesla lost X lost 35 billion since he took over. I don't even know if this makes sense. Mike said, straightforward question, only if you can answer, please.
Sure.
But I think it doesn't really make sense. I'm trying to answer all the questions. This one, I don't know. What's the yearly return on options trading as compared to the 11 to 15% yearly average on S&P? But that's going to depend on who the trader is and what they're trading.
Yeah, I can't answer that. What I can tell you is that what you should not compare it to what the S&P returns are, because S&P returns can fluctuate dramatically. We just happen to have been in a bull market. What you need to compare your option returns to is to risk-free rates. And so right now, if you look at risk-free rates, let's just say they're 5%. They're actually a little lower than 5%, but let's just say they're 5%. So you have to compare your trading returns to that 5% risk-free rate. If your trading returns are in the 5 to 10% range, then you have to consider, okay, well, maybe I'm learning something, but maybe I'm not that good at this, or maybe this is harder than I thought, or any of that kind of stuff. But what you want to ultimately strive for is some multiple of that 5% number. So like Adam might say, hey, I'm shooting for, 6 times risk-free rates or a 30% return. I might say I'm shooting, and some of it depends on account size, some of it depends on lots of stuff. I might be shooting for, a 20 to 22% return or 4.5 times risk-free rates. Those are, whatever number you're looking for is great, but just 7.5% relative to 5 is not worth it. The resources, the commitment, the time, the risk and everything, you deserve to be paid for taking risk. And it has to be some multiple of risk-free rates. I don't care what the S&Ps are doing. That doesn't mean anything to me.
Got a lot of really good positive energy going through right now. We did put the link up if anyone has not tried to check out a Tasty account where you could earn up to $5,000, which is a lot in bonus prizes. Not prizes, sorry, rewards. Rewards. I'm still on the Contango game, but you should definitely check it out. I could also say, Tom, it's a gratifying feeling. I got the company back at the end of last year, and I said it's going to take a little while to build back the community because they've been hit hard from the way they've been being run. But there's been a lot of people on this call with a lot of energy, and that warms my heart. It's good to see. And then some really nice comments. Linda said this is a priceless call. Looking forward to getting the replay. Karen said you guys rock. Will you do a replay so I can absorb both of you? I also have Schwab and don't love it as much. Jim said this was excellent. Thanks. Got it. Excellent. Thanks. Bradley said kind of an open question, but do you prefer selling premiums that go to a trade or spreads or cash secured puts?
Well, I don't do a lot of cash secured puts because the only place you would do a cash secured put is really in a retirement account, in an IRA. And at Tasty, we're a little different than any other firm. We let you trade anything you want in any type of account. So the requirements might be a little more in an IRA account, but we don't have restrictions against doing, certain things and strategies and naked options, things like that. So which is nice. But I don't generally do cash secured puts. That would be like a covered call. It's like a cash secured put. And that's not really my style. I will occasionally with an inexpensive stock and a cheap stock, like a $10 stock, I'll do a covered call or something like that. Like if I was trading SoFi, like you mentioned earlier, Adam, like I might trade a covered call in there if I was bullish. But for more expensive underlyings, I would prefer to sell an out of the money put or an out of the money put spread.
And that would be called a professional trade.
It would be called a high probability trade in my world. You could call it whatever you want. Yeah.
And that goes back to the beginning of this call when I said you're a better trader than me because you make high probability trades. So it's not you're only as good as your last trade because it's the math is going to work out for you over the long run. And I'm starting to do that more. I've become much better at that. And by the way, still so many more comments coming in, so many different people. These calls are the best.
Awesome. I love that. That's
Jesse's
great.
trying to open an account right now.
Awesome.
Michael, thank you so much to both of these. AS, love these calls. TastyLive.com, Mary Jane said, is an amazing teacher. So much research and so many strategies. And then Brody said, I have a long, and this isn't trading advice, but he said he's long meta call option expiring December 2025. The call is up 85%. Congrats. Going into earnings, how can I hedge that call option for any downturn?
If you're up 85% on the call that you have, sell a further out of the money call against it and make sure you get about 30, make sure you collect about 30% of whatever call you have, you want to get about 30% of the delta so that you reduce your risk by about a third. And that's the best thing you can do. You don't want to buy a put against it. But you're fine selling another call, a further out of the money call against it and collecting some premium. In an ideal world, you would like to collect enough premium to offset the expected move. So what was the stock again, Adam? I missed the name.
Meta.
Oh, Meta. Sure. So let me show you something interesting. It's a little harder in Meta because Meta is an expensive stock, but the earnings move this week in Meta, because Meta has earnings what is that, tomorrow? You see this move right here in the 3 days? It has about a $46 expected move in Meta. That's a huge move. Just to put some context around this. So this person is right now, you said they have a December 25?
December 25.
Okay. So they have a December 25 call out here, which is 416 days away. What I would do is I would sell a December of 24 call against it, and knowing that the expected move is $46. I would probably try to reduce a portion of that. So I would look at somewhere around, I'm just guessing. Now, when this person says they're up 85%, I don't know what that means. If they're long an out of the money call and it's a cheapie and whatever, but assuming it's an at the money call or something like that, I would sell some call up in here around the 30 delta and try to collect, $15, $16, $17, $14 and sell that against that far out of the money or that far in the money Meta call and just reduce your risk by about 30%.
Right, but that might not make sense if they bought a 700 call or something stupid.
That's right.
Not stupid. Sorry.
I don't know that. Right.
I'm not saying stupid like that. I'm just meant
whatever call you bought, sell something further out of the money.
I was saying that if you bought a 700 call, that would be a stupid play. Not you, right. Everyone else. Sorry. I don't like to use the word stupid because I really love when people ask any question. Nobody was stupid in that scenario. I was just saying that what I was suggesting would have been a mistake. It's the 455 call on December 19th, 2025. So you're good.
Yeah. Sell that $30 call to your hands.
Congrats, Brody. Take us to dinner. And by the way, I guess I always leave them on more. I got to go to the Yankee game, but there's so many questions flying in and positive.
Well, listen, Adam, we've been doing this now for 10 years, it feels like at least. Yeah. I love every single one of them. I mean, we we can do them as whenever you want. There's
I'm just really happy. I love good energy. I thrive off of this energy. And by the way, though, like you're selling out because we just let Brittany know that we didn't have any more calls scheduled and we wanted to get more on the books. And she said you're sold out November and December.
No. I can do December, November. I'm doing a tour through Europe. I'm doing a bunch of live trading shows because we're rolling out new software in Europe. So I'm kind of on a crazy schedule. I think I'm good at the,
we were talking January, February, but if we could get one in December, we won't.
No, you can easily get December. I'll override her.
Okay. This one, Lisa said this one was special. Hope there's a replay. Okay. This is so informative. I love that. I could just keep reading. Tom, I'm telling you, these comments and your team will tell you. It's just not only is it nonstop coming in, which is all you could ask for. For me, for Tom and I, all we thrive off of, it literally goes back to like if you're coaching kids. All you want is a coachable kid with a good attitude, and it makes the job much more rewarding. So when we come on a call like this and you all are participating and firing questions and follow-up questions, you're driving this conversation, right? And so when you do that and all the comments are coming in, it just gets us more excited. It always makes for a better call. So thank you. The audience wins the day here, MVP. This is fun, and I love that we're leaving them wanting more as I head to the Yankee game.
I was going to say you're going to be tight.
Oh yeah, always. I live my life like that. Tom, thank you so much. We'll follow
Thanks,
up,
everybody.
and really appreciate you and enjoy the tour of Europe. And we're gonna push hard for a December date. Thank you.
Yeah, we'll get one. Thanks, everybody. Thank you guys so much.
Bye.